The union budget is one of the most intriguing and important exercises of the finance ministry every year. And this is like a roadmap that's given every year in terms of what the government is going to do with its finances. Where is it going to get its money from? Where is it going to go and spend that money? And basically, that's why it holds a broader importance for the economy as such, as it gives a direction of what the government is trying to do. Right. In this session, we're going to look at what are the major expectations with the upcoming budget, and what broadly could play out because of that. So we're going to quickly start with the previous budget estimates. We're going to look at the theme of this budget. What are the major themes that are likely to play out in this budget? We'll see what to expect on the fiscal front as such, any kind of disinvestment targets that might play out, expectations on the income tax front, and finally, sectoral implications of the decisions that are made by the Finance Ministry of India. Right? That's the broader backdrop of what we're going to kind of cover in this next 40 to 45 minutes. And we'll try and kind of ascertain what are the likelihoods of some of the activities happening there in this budget. Of course, some of these are our opinions of things, and that may or may not kind of play out. But let's see if things play out the way we expect them to, what impact it has on the overall investment climate in the country. Right? Before we begin, let's look at a quick check on last year's estimates around the budget. So this is last year budget and what the estimates were given by the government of India. Numbers in INR crore and converted to US dollar billion at the rate of 65 rupees to a dollar. Right? At this rate, there has been a conversion that has been done. If you look at this closely, the gross tax revenue, this is center plus states put together. This includes direct and indirect. This is revenue that is collected by the center and then shared. A part of that is shared with the states. This is not exclusive revenue collected by states. That's separate. So that is not here because that's not the central government budget. We're only looking at the central government budget. So this number is basically your income tax, corporate tax, plus GST, plus any other kinds of custom, excise duty, etc. coming in together. From this, there is a net to the center transmission of this. So some part goes to the states. Roughly about 65% of the total tax revenue goes to the center. There's non-tax revenue, which includes things like dividends from the entities where the government holds stakes, dividends from RBI, etc. There is small recovery of loans, and then there is this target of disinvestment. Right? You add up all these numbers, you add up 1, 2, 3, and 4, you get the total revenue receipts of Government of India. 233 plus 2 plus 11, that's about 246. You will get 1, 2, 3, 4 added will be $246 billion, right? On the expenditure front, there are two kinds of expenditures. Revenue expenditure, which is, so let's actually define capital expenditure first. Capital expenditure is anything that adds an asset for the government. So if the government goes and builds a bridge or infrastructure or goes up and puts a power plant by NTPC, that's all capital expenditure. Anything else that does not add an asset is basically revenue expenditure. So this includes stuff like salaries, this includes stuff like subsidies, interest payments, anything else that does not fall under capital expenditure goes under revenue expenditure. Revenue expenditure is largely inelastic in nature, but at the same time, it doesn't grow dramatically fast. Right, so that's the $283 billion. Nearly 85% of our total expenditure of Government of India goes to revenue expenditure, 15% goes to capital expenditure. That's the broader contour of the breakup. That gives us the total expenditure as 330. Total receipts were 246. Total expenditure is 330. The difference of 84 is basically your fiscal deficit. Correct? Now, fiscal deficit as a percentage of your GDP is 84 divided by your GDP, which is 2.5 trillion approximately. So 84 by 2500 is going to give you 3.2%. That's the target that Government of India gave last year, right? That's 3.2. And this is the amount that will have to be borrowed. You have to borrow this amount. So that's the broader contour of what were the estimates last year. There are some hits and misses in this. So this final number of fiscal deficit last year is now expected to be about 3.4 to 3.5%. That's primarily happening because the tax revenues are lagging. And why are they lagging is because GST implementation has been slightly slower than expected, and the government obviously is feeling the heat around that. It would have been worse but for the fact that these other receipts are going to cross 90,000 crore, right? We'll look at that as how that works in terms of the disinvestment bit. That's going to cross 90,000 crore. That saved a little bit of face for the government in terms of the fiscal deficit scenario. This is last year estimate. Now, obviously, we'll look at what kind of projections we can expect in the coming year and see whether it makes sense to look at those projections or not. But before we go there, we will look at broadly what do we expect in this budget. Now, this budget is a classic case of a fight between populism and fiscal prudence. Generally, you would expect a country like India in the last few years has maintained reasonable amount of fiscal prudence, much better than a lot of the other countries in the world, much better than what most of the markets or participants in the markets would have expected it to, right? However, in 2019, we head into elections, and this might very well be the last full-scale budget before the elections. There are two other points that come there. So one, you're heading into elections that are coming in. Two, in previous elections, you have seen a sort of a slowdown in rural growth, right? So now, that is despite a couple of years of good monsoons. You've seen a slowdown in rural growth, and the government would very likely not want to get into the elections uh, putting their fate in the hands of monsoons this year. So if monsoons fail this year, then are not as good as what is expected this year, then obviously the rural economy could create a lot more trouble. It was seen in previous elections in Gujarat that the government, the incumbent party BJP, basically lost a lot of seats in the rural hinter parts of Gujarat, and it's widely expected that there is probably going to be some sort of a populism around the rural growth boost in India in the upcoming budget. You expect populism anyway in terms of elections that are coming in. The final bit is obviously the general voter base of the incumbent parties is kind of struggling with the implementation of GST and demonetization. So the government might very well try to kind of give a little bit of sops around it and see if that helps the entire set of the voter base in general. The argument for fiscal prudence is obviously the fact that if you try and miss this by too much, then it could become difficult to control in case they come back into power next time, which is anyway widely expected, right? So you don't want it to go too much out of control just in a bid to kind of go and win the elections. Two, you may not have the resources, right? So what are the resources that are available in the first place to kind of go ahead and do wide scale populism? You can't keep borrowing from the markets and expect that things will be kind of coming back on track. Third, you want to kind of boost growth, and so consequently you don't want to do things which start tinkering with that. So for example, if you become too populist, you will have to borrow more. If you borrow more, interest rates will go up. If interest rates go up, then you will have a problem in boosting the growth. You don't want those kind of outcomes also playing out there. So practically, it's a bit between populism and fiscal prudence. A lot of the market participants actually expect populism. In fact, if you have followed the stock markets for the last few weeks or so, you would have seen that almost all the sectoral plays around rural growth and consumption growth have kind of done remarkably well. And a lot of this is to do with the fact that historically during election years, there is generally a lot of money flow that happens in the economy, right? And that basically just boosts the entire consumption pattern during election years. So that's expected. And we have to see what kind of line the government draws in between these two levels that come up. If you look at the key themes for this budget, there are 3 or 4 clear themes that are evident, which is rural incomes. The government has reiterated post the Gujarat elections that they want to double farm income by 2022. So they want to do it 2x by 2022. So obviously anything that has to do with rural incomes or farmer income is going to probably be a key theme in this budget. They are likely to kind of provide as much outlay possible to these plans around rural segment of India. Affordable housing is going to be a key theme because that's what they had also promised when they came to power in terms of giving housing for all by 2022. And people would be keen to notice what happens there. In general, housing and real estate kind of are big employment generators. So you would probably want to boost that significantly because it's a very localized employment generation scheme that plays out. So you want to kind of boost infra in that context, right? Local production in order to again create jobs as well as kind of control your imports. So you want to kind of take your imports lower. Anything that you import, the government is likely to kind of boost its production locally. It could be electronics, it could be consumer durables, it could be capital goods like boilers, transmission, power lines, etc. Whichever things we import from the global markets, there is likely to be measures around that, either in the form of higher duties for imports or in the form of more SOPs for domestic consumption, domestic production of these things. Road and rail infra, it's highly expected that the government is going to channelize and focus specifically on road infra creation along with an outlay around railways. Road purely because the connectivity automatically boosts a lot of the growth in the economy, and that's probably one of the agendas, again one of the bigger employment generators in the economy. And so consequently the government is likely to kind of boost that within the capital outlay. One final theme that we think is going to be intriguing is the pollution bit. So anything that reduces pollution is going to get a positive outlay. Anything that increases pollution is likely to see a negative impact here. This is going to become mainstream pretty soon, and it is very likely that governments are going to kind of focus in subsequent years on a lot of these parameters, right? So what could be plays on pollution? Electric vehicles are going to be a play on pollution. Boosting of public infrastructure is going to be a play on pollution. Any kind of industries that generate a lot of pollution are likely to get restricted, or there are going to be incentives to reduce that pollution, right? Let's look at what kind of firms would probably benefit out of this. So if you look at rural income, farm equipment, tractors, etc., irrigation systems are likely. Rural consumption oriented themes, stuff like ITC, HUL, etc. Rural housing and agri products, fertilizers, chemicals, etc. that come in. Affordable housing, any kind of urban construction theme, housing finance, housing equipment, all your tiles, etc., variety of stuff. Cement, these are the likely beneficiaries of the entire scenario. Local production, consumer durables, steel, capital goods. Steel and capital goods we typically import, or steel is gets dumped by China. Capital goods we import from global players. And consumer durables, again, we are a big importer because locally we don't produce too many televisions or mobiles, etc. In India. So there is likely to be a policy boost around that entire thing in the times to come. Road and rail infra, logistics sector, commercial vehicle sector, and railways infra plus anything that goes towards railway safety and road safety is going to be big in terms of nature. Pollution, specifically industries like chemicals, it's going to be negative because it is a polluting industry. Anything that pollutes, it's going to be negative, and that's likely to be your, for example, cement plants that use something like pet coke. Right, so pet coke is used as a raw material in cement, and it's a polluting agent in general. So there was a brief ban on pet coke in northern parts of India recently, and it's likely that some of these processes might get penalized. Within power, thermal power, etc., is going to get less incentives, and renewable energy is likely to get a lot more incentive. In general, we think that your public transport could be a significant play here in outlays on metros, etc., across cities, just trying to kind of control pollution. Because if you wait for pollution to reach hazardous levels in a lot of the second tier cities, after which you kind of implement public transport, that's not going to work. So you have to basically incorporate that right away. We expect that's going to be one of the key themes in this budget as such. So expect a bigger outlay on public transport, expect a bigger outlay on electric vehicles, buses on that platform, outlay on creating infrastructure around electric vehicles, outlay around solar energy that is there. So a lot of this outlay is expected in one of the key themes in 2019 that plays out, right? So that's something that is extremely important, and we could look at that in detail as we go along. Some specific segments which are outlay on the rural side are likely to be much higher, right? So if you look at schemes like MNREGA, etc. So look at last year allocations of these. The rural employment guarantee allocation was about 48,000 crore. Pradhan Mantri Gram Sadak Yojana was about 19,000 crore. And housing, Pradhan Mantri Awas Yojana, urban and rural, 6,000 and 23,000 crore respectively. This 23 has actually grown dramatically in FY16. FY17, this number was about 15,000 crore. In FY18, this number has gone to 23,000 crore. And it's fairly likely that this is going to see another big increase here. So if you expect a 20-25% kind of a jump in the overall outlay, that would mean an extra outlay of about 4 to 5 billion US dollars. Right? Just keep these numbers in your mind. Broadly, our total expenditure is about $330 billion last year, and we're talking some terms around that. Our fiscal deficit was about 85 odd billion dollars last year. So when you look at a 4 to 5 billion dollar, take it in that context of what kind of impact it might have on the fiscal deficit, and where is the government going to raise money from this for this kind of an allocation. But expect that anything that is in the rural segment is going to see a much bigger allocation, especially heading into the elections. If they have to do course corrections, they'll probably try and do that next year, right? So that's one of the things that I think is going to be very, very clearly a dominating factor in this particular segment. Now, what could potentially be the projections for next year? So we've just assumed certain numbers here, and we have taken these revenue receipts and expenditure receipts from the last year around, and we have assumed a certain amount of growth there, right? So we are assuming a gross tax revenue increase of about 14%. We will check whether that is possible or not possible, but let's assume if we go and look at specific to 14% kind of numbers, then what happens to the overall tax number? What happens to the tax revenue net to center? Non-tax revenue is expected to grow at 11%. Then we are assuming other receipts, specifically disinvestment. Right? This is expected to grow at about 30% from this initial outlay. That initial outlay is now beaten this year. The government is likely to end up with 90,000 crore this year. So from there, it is actually not too much of a jump. We expect next year also to be around 90 to 95,000 crore on FY19. The expenditure budget is expected to increase by 10%. Now, revenue expenditure usually rises at about 5 to 6%. But it is likely that in the election year, the government is going to boost this expenditure via outlays on a variety of projects in terms of salaries, in terms of subsidies, etc. That's likely to get boosted. Capital expenditure historically has been growing at about 11, 12, 13%. It is possible that this particular year, they might just wait a little bit. It's honestly not too big a number. So even if it moves here or there a little bit, that's still about 15% of your total outlay that is there. Right? What does that bring us to? So we're looking at a total receipt by Government of India to the tune of something around, roughly 265, and 265 versus 52 versus 363 is what we are looking at. That's a shortfall of roughly about 99. This has not been counted because we have not looked at it whether it is perfectly in place or not. If you remove the disinvestment bit, you are likely to see a fiscal deficit of about $99 billion. If you remove the fiscal deficit from the picture, if you remove the disinvestment bit from the picture, you're likely to see a fiscal deficit of about $99 billion. I'm assuming that the current year GDP is, as per the advance estimates that are there, converted to dollar billion. So that's about $2.5 trillion of GDP. If you assume that nominal GDP growth will be 11.5%, that's real growth of 7.5%, plus inflation of close to about 4%. If it grows at this rate, next year GDP is going to be 2852 billion. You're looking at about 3.4% fiscal deficit there. On the contrary, if you do get this inflow, then you're looking at a much lower fiscal deficit. So there are ancillary assumptions here. One, if you get this disinvestment, you could actually boost up construction or infra even more. If you do not get this, you still are at roughly about 3.5% of GDP. So you're not really too far off from where you are. That assumption, however, hinges on the fact that your tax revenue grows, right? So it kind of assumes that tax revenue grows. Now, the tax revenue growth effectively, if you take the total overall tax to this number, $335 billion by growing with 14%, this would take the tax to GDP ratio to about 11.75%. This year, tax to GDP was about 11.3%. This is one of the lower in most of the major economies of the world. The government is trying to boost it up to 12.5 to 13% by 2022. And so it's an okay assumption in our understanding that if you're looking at 11.75% next year, it's not going to be too far from here, primarily because of higher compliance. And we're going to look at specific reasons why this might reach 11.75% there, right? The interesting bit could be disinvestment, and just the way all the structures are coming around disinvestment, we could look at what are potential targets next year on disinvestment, and consequently what is the outlay that the government is likely to put ahead in disinvestment. Given that stock markets have done well, it is likely that the government will go and sell stake in a lot of the entities this year, right? So we'll look at that. Now, can tax revenues grow at 14-15%? That's the primary question that comes into our head, right? Let's look at that. So tax revenue in India, if you look at the last 2-3 years, so that's actuals, that's revised estimates of 2016. So there's 15-16, 16-17, 17-18 budget estimates, right? If you look at this component, this is direct tax. If you look at this component, that's indirect tax, right? Now, out of the direct taxes, the first one is corporate tax. Last 2 years have not been too good for corporate tax, growth, earnings growth. If you look at generally most of the companies in the top indices of India, Nifty or Sensex, you will see the companies have not really grown too much. Despite that, corporate tax grew by about 10% here and grew by about 10% here as well. It's expected to do that, right? Now, in the coming year, you expect earnings to revive. Corporate earnings are expected to revive this year. And in 2019, you generally expect at least the top companies around Nifty, etc., to grow earnings at about 20%. If they're expected to grow earnings at about 20%, you're likely to see better tax collections on the corporate tax front, surely, right? Income tax has been very intriguing. Personal income taxation, despite actually reducing the effective tax rate on by widening of tax slabs, you saw roughly about a 25% growth here, and you are expected to see roughly about a 22% growth here, right? You are expected to see much higher compliance in the coming year, purely because systems have come in place, more people have started filing returns. Those who have started filing returns in the last 2-3 years, they may not be paying taxes. A lot of the people actually just file returns. They don't pay taxes because they don't fall into that slab of income tax payment, right? They are likely to see a higher growth in their incomes this year, obviously because corporate earnings are expected to revive. As they get higher salaries, you're expected to kind of see a jump in income tax collections as well. In general, a combination of compliance and a combination of generally better tax provisions and better earnings that people would have, you're likely to see these collections. In the years where you didn't have this playing out, you still had reasonably good collections. You are likely to kind of look at this entire scenario that plays out, right? So that's the broader contour of things that are there. There's a quick point around recapitalization expense around the banking system that might come in. Just note that recapitalization bonds that is going to happen for the banking system, the government has said it is going to be an off-balance sheet item. They're not going to look at it in the budget context. Now, they'll have to raise that money, and we are yet to see a broader finalization of where they are going to raise that money from. But in terms of their expenditure statement, it is off balance sheet is what they've said. It's not going to be on the balance sheet, right? That's the broader premise on direct taxes. So you can very likely expect direct taxes to grow at 15 to 20% in the coming year. That's going to be an interesting phenomenon. Just keep in note this number of about $68 billion, right, on personal income taxation. This is an interesting number because we also expect the government to provide SOPs for lower income segment in this upcoming budget. So we'll see what happens there. This entire spectrum has gone under GST, right? So with the rationalization of GST happening, you would expect that next year revenues are going to be intriguing and better in that context, right? If you add up these headers, you work at about roughly around 9 lakh crore. If you see this, right, approximately 9.2, 9.3 lakh crore. GST collections at this point have hovered between 80 to 90,000 crore, which should match this estimate in the first place. Secondly, next year, once the system stabilizes, you expect bigger revenue generation out of that. And so that's likely that GST is going to kind of improve, and that's also going to increase the tax revenue. So we're pretty hopeful that you will see tax revenues grow by 14 to 15%, and that should give a lot of leeway to government in terms of their spending. They are likely to project this in the budget. Whether it falls short or not is to be seen in due course of time. Right? Now let's come to the income tax payment. Remember we said $68 billion was the total tax collection on incomes. Remember that bulk of it actually comes from the top tier in terms of the top earners. Bulk of India's tax comes from this. So in the last budget, the government has actually given some of these estimates saying that number of people in crores who declared this income, right? So 0.99, 1.95 crore, 0.52 crore, 52 lakhs, and 24 lakh people in India actually declared an income above 10 lakhs, right? So that's the broader contour of what exists. Not a lot of tax revenue gets generated by this strata. Bulk of the tax revenue on the direct tax comes from the final strata, that is the highest income bracket that is there. Now, at this point of time, the slabs obviously exist in a certain context, and the current slabs are these. So, up to 2.5 lakhs, you see 0. 2.5 to 5 lakhs, you see 5% income tax. 5 to 10, you see 20%, and above 10 lakhs, you see 30%. That's the current slab, right? Now, what is the likely impact of a radical tax reduction in income tax, right? Let's assume there is a radical reduction, and let's assume the radical reduction is something like nil tax up to 5 lakhs and 10% from 5 to 10 lakhs of income. Instead of 20, the government reduces it to 10. So if the government reduces this to 10%, obviously there's a revenue loss, and they're saying that up to 5 lakhs there's no tax, so there's a revenue loss there as well. Now, what is the likely revenue loss? So if the current taxation structure is looked at, what is the average tax paid? Let's assume that in this bracket, so let's assume that the average income of this segment between 5 to 10 lakhs is 7.5 lakhs. So if the average income is 7.5 lakhs, what's the likely tax implication? You're likely to see 5% up to 5 lakhs. So that's 12,500. Remember, 5% between 2.5 and 5 lakhs. So if my income is 7.5 lakhs, I'm going to see 12,500 here, and I'm going to see 20% into 2.5 lakhs. So that's 50,000. So the likely average tax paid is about 62,500. Anyone above 10 lakhs of income is going to pay 12,500 up to 5 lakhs, and 1 lakh between 5 lakh and 10 lakhs, right? Because that's a 20% slab that gets applied there. So the tax is either greater than 112,500, or for this segment on an average around the number is about 62,500, right? Now let's assume you cut down the slabs to 0, and 10%. So the average tax paid here at an average income of 7.5 lakhs is going to be 25,000, and saving from here is going to be about 37,500 per person on average. And in this segment, the tax is going to be only above 50,000 because you would pay nothing up to 5 lakhs and then 10% above 5 lakhs. So the average saving here is going to be the difference between the earlier number and this, which is going to be 62,500. Now, I'm not saying this is likely to happen, but if you multiply these 52 lakh and 24 lakh people with these savings, the total reduction would cost the government about 35,000 crore or nearly $5 billion. Right? It's important to understand the contour of what it would do. Remember that this is going to be a significant advantage for anyone who's in this slab, would encourage a lot of people to actually come in this bracket and start declaring their incomes and put returns in, increase compliance in subsequent years, and at not a very large cost. The total income tax collection by the government is 68 billion. And we are saying that this segment, this entire segment sub 10 lakhs, if you give a reasonable SOP to them, it's going to cost you only about $5 billion, 5 to $5.56 billion approximately, right? So that's a very mouth-watering prospect from the government's perspective, if you think about it. So it's likely that you are going to see some radical changes. We're not sure whether it will be as radical as what we say, because honestly, the number is still not huge from a voting perspective, from an election perspective. If they generally want to boost spending, this is a good strategy to try and boost spending, because on average, if everyone has anywhere between 37 to 60,000 rupees to spend, that's likely to increase consumption dramatically in the economy. And that's basically what income tax profiles could get changed to. If that happens, consumption is going to see a big boom in the economy, right? One possibility exists that the funding of these tax SOPs could happen by introducing something like a long-term capital gains tax on equities. That does not exist on equities at this point of time. Now, we believe that this possibility is low, and even if that happens, to an extent, it is already priced in. One, we don't know the actual revenue projection for the government for this, because at this point, we don't know if you introduce the LTCG, long-term capital gain tax on equities, how many people would actually be selling stocks in that time frame. Most likely, even if it is introduced, it's likely to be a scenario that rather than, so currently what is the scenario is long-term capital gain tax is 0 on equities and short-term capital gain tax is 15%, and the distinction is 1 year. If you hold a stock for less than 1 year and you sell it and you're making a profit, you'll pay 15% of that profit. If you hold it for more than 1 year, even if you're making a profit, you're not going to pay any tax on that. That's the rule as of now. The government is likely to probably introduce some tax here. That's one of the rumors that's doing rounds in the market, because obviously they might fall short on tax elsewhere. The other thing they could do is just increase this number to 3 year. Instead of 1 year, they could increase the holding period to 3 year. So by logic, a lot of the people who are selling after, let's say, 1.5, 2 years will fall under the short-term bracket and start consequently paying some tax on this. This may not be a bad move because this would encourage long-term investment. So in general would reduce the speculative flavor of the financial markets. It's not a bad move in the longer run. In the short run, the stock market might kind of take it slightly negatively, but at least to a certain extent, everyone in the market knows about this. So the market might be pricing in a little bit of news around long-term capital gain tax. If it doesn't come, the market is going to treat this positively. That's the first part around it. The second part around taxation is obviously if you don't get revenue, will disinvestment come to the rescue? So what we have listed here is the top 10, 11 companies. The 11th one is not the top 11th company, but I've just put it there because of a certain specific reason. I'll explain that in a minute. So these are the top 10 companies, PSU entities in order of market capitalization. This is the stake of the government in this, right? What is calculated here is the value of the stake above 51%. So 68% minus 51%, that's the extra 17% that the government holds. 51, 57 minus 51, 79 minus 51. Technically, if they sell this stake, they will still be a majority holder, right? So they can just offload all this. If they do this in just two companies, Coal India and ONGC, they will meet the entire target for next year, 90,000 crore, right? So technically, that's a possibility that can happen. That's one possibility that could happen. The second thing government could do is what they recently did with ONGC HPCL, right? So ONGC basically went and acquired the government stake in HPCL, and this paid the government somewhere around 36,000 crore, right? That is what led the disinvestment target to reach higher this year. Now the government is already saying that BPCL could acquire GAIL and Indian Oil could acquire Oil India. And this is the entire stake that is worth. That's why I've listed and highlighted these two. If that is going to happen, you're going to get about 57,000 crore directly. The government is going to get 57,000 crore in this bit, and you're likely to kind of get this number. So what we are saying, just to quickly summarize this, that the government has these companies and stake in these companies. These are all PSU entities where the government has a certain amount of stake. And this is the stake that the government has. If they sell up to 51%, which means in ONGC they can offload 17%, in IOC they can offload 6%, in Coal India they can offload 28%, then that is worth this much in this column, 43,000, 48,000 crore. You add up all this, that'll work out to somewhere around 1,30,000 odd crore. And these are just the top 10, 11 companies. In addition, what they could do is what they did with ONGC and HPCL kind of a deal, where ONGC buys the government stake in HPCL for 36,000 crore. The government is already saying that BPCL will acquire GAIL and IOC will acquire Oil India. Now, government stake in GAIL is worth 41,000 crore and Oil India is worth 16,000 crore. You add, that's already 57,000 crore. The entire year target is 90,000 crore, 95,000 crore, right? So technically, disinvestment is likely to come to the rescue. The government has also very clearly given an indication, as with Air India, that they are open to strategic stake sales in this. They could also do it in some of the financial firms like SBI, etc. But we believe that there, because they're trying to recapitalize, it's unlikely that they're going to do stake sale there in general, right? But non-core assets are going to get sold. In fact, these are PSU entities. The government also holds minority stake in companies like ITC, Axis Bank, and Hindustan Zinc. And that itself could be worth a reasonable amount. The government could also offload that stake during this year. So disinvestment is likely to bring in a reasonable chunk of revenues. Given that markets are doing reasonably well, the government is likely to announce a slightly more aggressive disinvestment target this year. Let's see what plays out there. This increase in disinvestment, if you just think about it in terms of a broader sense, we said that the entire reduction in income tax would cost government 35,000 crore. They could get the entire thing by just kind of, creating a similar structure like ONGC, HPCL with any of these firms, right? Any of these firms could basically come in and you could merge two firms there and you could get this. For example, let's say NTPC buys Power Grid, just argument's sake, right? So effectively, you could generate that amount of revenue right out of this one single stake sale that happens. And so that is where I think there's a lot of crux of what might play out in the next year on the disinvestment side of things. Let's quickly summarize what's likely to happen on specific sectors around this budget. The banking sector is likely to see the recapitalization plan outlined in this budget. Other than that, there are going to be minor tweaks, but primarily you're going to see a continuation of the resolution of the NPA scenario. Right? NPA resolution is kind of continuing to take the center stage. Metals, you're likely to see import duties and infrastructure outlay. That's going to probably create a demand for metals. Consumer durables, things like mobile phones, televisions, etc. You will see a domestic production boost because that's a big import for us and the government wouldn't want to spend too much money importing stuff, right, to control the trade deficit. They are likely to put lower effective tax rates on these companies to kind of boost production. In addition, lower effective tax rates could boost consumption, right? If everyone has 50,000 rupees extra, they're likely to go and spend it in consumer durables. So that could boost this segment. Housing finance is likely to be boosted given affordable housing. Affordable housing also comes in real estate. So you're likely to see higher benefits in order to give a boost to real estate segment under the taxation slabs that come. And under affordable housing, there is a certain carpet area that is limited. You probably might see more bigger houses also qualifying for affordable housing. So that's generally going to be good for the real estate sector. Overall outlay on infra is going to keep infrastructure sector in the focus. Higher allocation to rural schemes is going to be a big boost for FMCG and agri product segment. And in general, the consumption theme is going to play well if you see lower effective tax rates. Now, that's an assumption that we have, that you're likely to see lower effective tax rates. Let's see to what extent it plays out. But that's the broader segment of sectors that are likely to do well. Make no mistake, this is not a recommendation to go and buy into these sectors, because a lot of these sectors like FMCG, agri products, consumption theme, housing finance, etc., have already run up significantly in the last year, anticipating these. If I know this, you know this, then most likely the stock market also knows or is anticipating this by now, right? So unless there is a surprise on the upside on some of these places, you are not likely to see a substantial move in terms of stocks. The companies obviously will benefit because they will get better business out of this entire thing, right? We already have a very recent news that comes up where the transport ministry, road and surface transport ministry, is saying that they are asking extra 25,000 crore for the next fiscal year. This year they are spending about 70,000 crore. From the next fiscal year they are supposed to be spending around 1,40,000 crore. That's double. Fiscal year 2019-20, you're expecting around 160 crore, 1,60,000 crore. And so effectively you are likely to expedite the entire road projects that are going to come on, the entire infrastructure outlay that is going to come in, and it's fairly likely that that is going to be one of the big beneficiary segments out of the entire exercise, right? That's what we are seeing. Now, to just summarize the broader provisions that we are seeing, it's likely that the government is going to say the fiscal deficit will be about 3.4 to 3.5% of the GDP. Depending on what kind of disinvestment target they give, they could move this around a little bit. The market might be not too happy in the short run with this, but I think given the fact that our GDP today is 2.5 trillion and is growing at 12% nominal terms on average, so you would see 2.8 next year and you would see 3.2 the year after that. When you divide your fiscal deficit by your GDP, the denominator is growing at 12%. So in a fast growing economy, you can get away with a little bit of fiscal, lavishness in spending in a couple of years in between. It's likely that that could happen, right? Higher tax revenues are likely to be forecast by the government on account of GST stabilization, higher compliance, and better corporate earnings. I think to that extent, better corporate earnings and higher compliance and GST stabilization, all three are fairly likely to happen. The higher compliance could help them go and reduce tax bracket. So it's likely to relax income tax slabs, which might be a positive surprise for a lot of the people in the markets. They may not be expecting a very big bang radical thing, but it is possible at the outline. A minor probability exists that the government could do something radical on this. There's no specific reason for the government to make this budget populist, right? They can actually announce a reasonably good budget here. More populist measures could be expected in ensuing months outside of the budget. You don't necessarily need a budget to kind of give populist measures there, right? Much higher allocation to rural India targeted schemes so as to boost rural incomes, and higher allocation expected on infrastructure, more specific to job creation. So anything to do with roads, anything to do with housing, anything to do with construction that creates a lot of localized jobs, you could expect significant outlays there. Rural India targeted schemes expect a 20 to 25% kind of a jump in the outlay for NREGA, for Pradhan Mantri Awas Yojana, Gram Sadak Yojana, etc. Right? That's broadly the summary of what we are likely to see in this budget. What kind of sectors are likely to do well or see good kind of outlay in the budget. And if we go back a couple of slides and see the broader themes, just keep an eye on all these themes that play out in this particular budget. That's it in this particular session.